Hello to everybody, our dear subscribers. FutureTrend channel is back to you. And as regarding today, we like to speak about probably the most interesting topics of yesterday's trading. And that's of course the plunge in the value of the British pound because of Bank of England appearance of Bank of England's governor, Mr. Carney. And we also like to raise the topic of United States central banker's speech from yesterday's. And let's first of all to speak about the British pound. You know that rate cut speculation and Brexit uncertainty is probably the most important themes to discuss among the traders at the moment. And for a long time the Bank of England had forecasted a normalization of its monetary policy in case of an orderly Brexit. That's over though. The realization is increasingly taking hold that the economic downturn in the UK is not only due to Brexit uncertainty, but also to the effects of the global slowdown. Bank of England Governor Mark Carney sounded cautious yesterday regarding the growth outlook, pointing out that partly due to the recent fall in Brexit uncertainty we are likely to see a recovery, but that this was far from certain. What was decisive for the market and why sterling ended up coming under considerable pressure was him pointing out in this context that the Monetary Policy Committee was discussing as to whether monetary policy easing might be a sensible way of reinforcing the recovery. Carney's comments should not come as a complete surprise, really, as two MPC members had already voted for a rate cut at the last two meetings. However, the market seems to think Carney's comments mean that the idea finds wider support amongst MPC members than previously assumed. The market is nonetheless only pricing in a 50 to 50% chance of a rate cut this year. We, on the other hand, consider a rate cut before mid-2020 to be likely, which is why we forecast further sterling depreciation. This pessimistic sterling outlook is confirmed by the developments surrounding Brexit. The first exchange between the UK and the European Union leadership in preparation of the imminent trade negotiations initially consisted mainly of both sides setting out their red lines, which unsurprisingly seems completely incompatible. It would seem that we face another confrontation of the pig-headed. For sterling investors, that results in increased uncertainty and thus increased exchange rate volatility. However, following 2.5 years of Brexit drama, that can almost be considered to be the norm. As regarding yesterday's speeches of United States central bankers, a number of former members, and among them Fed Vice Chair Richard Clarida, yesterday sounded quite content about how the United States economy had developed recently. Even the top dove James Ballard saw the risk of a recession banished and was therefore happy with current interest rate levels. Today's labor market report is likely to confirm this positive economic view that could provide some further support for the dollar short term, as the markets believe in further monetary policy easing is likely to slowly subside as the United States data continues to surprise on the upside and the Fed sounds increasingly positive. However, we urge caution against writing off further United States rate cuts too quickly. After all, the central bankers suggested that not everything was exactly perfect. In particular, inflation, which remains too low for their taste, is causing concern and is currently attracting particular attention. This means that the Fed's willingness to ease its monetary policy further remains high, as a result of which we assume that at the first sign of downside risks for the growth outlook, it will not hesitate to cut its key rate further. Thank you and see you tomorrow.